Today, we're going to completely shatter some of those comforting illusions you've been taught about modern banking. Get ready to rethink your entire financial mindset because we are pulling back the curtain on what we call the middleman game. So let's dive right in with a super simple question. You get paid, you deposit your hard-earned paycheck into your account. What exactly do you think happens to that cash?
I mean, most of us picture this giant, highly secure money warehouse, right? Heavily guarded, just sitting there waiting for your withdrawal. But the truth is, your money is absolutely not sitting in a vault.
Instead, the whole thing runs on a system called fractional reserve banking. Basically, banks act as these highly efficient matchmakers. They take your deposit, keep just a tiny fraction on hand, and immediately lend the rest of it out to someone else. And here's the wild part. When a bank issues that loan, they don't fire up a printing press in the back room. They literally just type new numbers into a borrower's account on a screen. Boom. They're effectively creating new money entirely out of thin air.
Which brings us to a pretty staggering reality. In a lot of modern economies right now, including the US, the actual required reserve ratio for these banks, it's 0. Literally 0%. So the absolutely crucial takeaway here is that banking, at its core, is just a spread business. They're essentially borrowing your deposits at a rock-bottom rate and then turning right around and lending that exact same money out at a much higher rate.
Now, this gap between what they pay you and what they charge their borrowers is what's known as the net interest margin. And this margin is the absolute core engine driving how financial institutions profit off of your patience.
To really put that into perspective, by late 2025, the banking industry's average net interest margin hit 3.39%. Now, 3.39 might sound small, but when you apply that to literally trillions of dollars in deposits, that margin is generating massive revenue.
But the contrast here is what's truly eye-opening. Because while the bank is pocketing hundreds of basis points in profit from lending your money, everyday savers, well, we're often handed a meager 0.01% yield in return. It's kind of crazy when you think about it. But we've got to ask, what actually happens when the illusion breaks? You see, this highly leveraged system requires absolute, unquestioning trust. And the second that trust vanishes, systemic risk kicks in and sheer panic sets in.
Just look at the recent collapse of Silicon Valley Bank. It's a textbook example. The Fed raised interest rates, heavily invested tech startups suddenly realized they needed cash fast, rumors started swirling on social media, and almost instantly, everyone demanded their non-existent deposits all at the exact same time. As Dr. Daniel Kaplan points out, these bank runs aren't just mathematical failures on a spreadsheet. They are deeply psychological events. They're fueled entirely by pure human anxiety and uncertainty about whether an institution is actually going to survive. And this creates what's called a deadly contagion effect. The panic from just one collapsing domino alters the subjective beliefs of depositors everywhere. The fear just spreads like wildfire across the entire otherwise stable banking ecosystem. So ultimately, money and liquidity, they're really just shared social constructs. At the end of the day, your perceived wealth in this banking system is only as safe as the collective belief of the crowd. So how in the world do you survive this heavily leveraged system? Well, you have to completely abandon what we'll call the Peter mindset. That's the archetype of scarcity and fear. You have to consciously transform yourself into a confident financial builder. You know, most of us are actually rigged to stay broke by these childhood myths. We've all heard the classic lie, right? Money doesn't grow on trees. And that kind of thinking just keeps us trapped in this perpetual survival loop. Biologically speaking, someone stuck in that Peter mindset spends money impulsively on liabilities. And why do they do it? Mostly to chase a fleeting chemical dopamine hit. They're just trying to mask the sheer exhaustion of running in the rat race every single day. If you want to flip the script, you absolutely must internalize this golden rule. Use the 50-30-20 budgeting method. That's 50% for needs, 30% for wants, and 20% to savings. Use that strategy to smash your debt, acquire actual assets that put money into your pocket, and completely avoid those useless liabilities. By upgrading your financial literacy, recognizing those biological traps of impulse spending we just talked about, and frankly refusing to settle for terrible bank yields, you finally start playing the game instead of being played by it. So, I'm gonna leave you with this final thought to ponder. Are you gonna let your hard-earned cash quietly build a middleman's empire? Or are you ready to leverage this knowledge to finally build your own?